development, the changes in the monetary architecture that we've talked about, over the course of the year. It's been a big year on this front, starting with the Genius Act, working on the Clarity Act, which hasn't quite come through yet. But this week we saw at a kind of conference, I think Federal Reserve hosted, Christopher Waller, basically Jerome Powell's number two most trusted kind of confidant on the FOMC board, or sorry, the Federal Reserve Board of Governors, FOMC member Christopher Waller, got up and gave a presentation about these skinny accounts they were kind of starting to consider building out a project for basically the integration of non-bank financial firms and fintechs or crypto firms, et cetera, onto the Fed's monetary architecture. So really what it is it's settlement. It'd be pretty much just access to FedWire and FedNow, basically just streamlining settlement of payments so that these firms could access these kind of settlement rails directly rather than coming in on some other member firms, who has a master account on the Fed and basically just parking and utilizing that member firm's charter. So what this would mean from the Fed's abilities, it can actually better regulate this. You'd rather have kind of the upstarts on where, the monetary system is heading, build it around you rather than have a layer between you, where these parties are accessing as a middleman and you don't quite know or understand what's going wrong. There's documented cases of banks who've then serviced these fintechs. Names aren't recalling me, but we've seen failures of these, where essentially just the accounting technology, the tracking, all of that was poor, and nobody had any oversight. And we've seen, business failures, bankruptcies of these institutions, like U.S. based, and then the customers of these firms are just completely like lost. They're wiped out.
Synapse.
A lot of times, what was it called?
Synapse.
Synapse? Yeah, that's the one I'm thinking of. But yeah, it's just been a complete disaster. You've got to pick up the pieces after the fact. No one has any protections, on this, monetary, framework. It ends up hurting your banks as well because there's, if there's a credit relationship, it just turns into a mess. So basically, this is the Fed pulling in the next kind of layer of build out in a monetary system towards itself. We'll see how this develops, but basically, this is what I view as the Fed going through an era of reform. This is kind of laying the groundwork for this centralized institution maintaining relevance into the 21st century.
Absolutely. And from my perspective, if you're a stablecoin issuer too, you probably want to have that direct connection. You don't want to have to go through an intermediary for everything who can, charge you higher fees, maybe during certain times of stress. You get charged a different rate, things like that. It gives you a lot more flexibility from that perspective too.
Yeah. So who's impacted? Like this really opens up the playing field. The large banks who own, payment network franchises for transaction settlement, both domestically and internationally. This kind of enablement, opening this up, along with the stablecoin rails, personally, our view, this is missing the forest for the trees. This is really about a bigger picture process of integration of a financial system around Bitcoin. But there is a threat here to kind of your legacy. Monopolists might be too strong of a word, but their entrenched positions on international trade or settlement of international trade, cross-border transactions, stuff like we talk about in the other kind of theme areas or headlines that we focus on. It is a threat. It's an attack surface that opens up for the entrenched legacy franchises. So we'll see how this one shapes up. It's something to continue to watch as this big unfolding of our lifetimes takes place.